Well, I want to get straight to these yields. How much higher do you think they'll go? And ultimately, doesn't that mean there's an opportunity there for money managers if you look at what's happening in Germany and other parts of the world where the real yields are negative?
Yeah, I think that's right. I think we've had a real regime shift in the world that we no longer are in this secular stagnation, deflationary type environment. And I think investors around the world do think interest rates and global growth is normalizing, and the central banks will be normalizing policy, and therefore there is this upward pressure on treasuries. That being said, I would say that in the end, treasuries are a very fundamental creature. Where they go to is effectively what the market perceives is where the central banks are going to peak out their interest rate hikes. Because at the end of the cycle, the yield curve is always flat. And we have a good sense of where the central banks are going. The central banks have given guidance. They think that the Fed funds will be hiked continuously over the next couple of years, probably rising to around 3%. Yeah. And in many ways, that's really the gravitational force on where the 10-year is going. There'll be some surges and drawbacks along the way, but there's a lot of gravity around 3%.
I like how you put that. The gravitational forces of U.S. 10-year. Let's put that up on a Bloomberg, and our clients can pull this up at GSpace, hashtag BTV Space 9395. In terms of the yields on some of the U.S. auctions rising to the highest level since 2008, the sheer scale of these moves over the last 2 years. You listen to what Goldman Sachs is now saying. They're seeing 10-year yields, which were at about 2.9%, 2.89. They see that rising to 3.25%, which is up from their previous forecast of 3%. I also want to dig into what Morgan Stanley has been saying in terms of this being just a warm-up, the potential damage, Anthony, from higher bond yields, the route that we saw last month, that was just an appetizer, as they put it. Do you agree with that? At what point does it become hurtful?
Yeah, so as of now, there really is not any evidence that this level of rising rates, and they've been rising for a year now, that it's starting to weigh on the economy in really any direction. The consumer is actually doing stronger than we've seen. Corporate profits are increasing month by month. The reversions are positive, and analysts are saying they're putting in higher rates into their corporate earnings forecast, but still the forecasts are going up, not down. So I would argue that actually all bull markets coincide with rising rates, and at some point it may weigh on the economy, but I think it's premature to say there's any evidence that, say, 3% level of long-term rates is really weighing on the economy in any areas, whether it's the consumer or the corporate sectors.
You said that you've got a good sense of what central banks are going to be doing. A lot of people would agree with you, and I know a lot of other people who disagree with you. We've got the FOMC minutes coming up. Are you looking for anything specific in terms of what might have been discussed at that last meeting?
So I think we're less worried about the specific commentary, but I think along the way they're going to give guidance on what this path is. The market is assuming that this is going to be a gradual hiking path, and I think the market is assuming that there's enough global economic strength and it's going to last at least a couple of years. And so that puts us on a trajectory where if we do a few hikes this year, a few hikes next year, then the Fed funds gets up to 3%. And I think that's really what the market needs to target is where is that trajectory going? Is it a little bit steeper? Is it going to end up at 3.5? Is the economy and the cycle so strong that this is going to last 4 years instead of just a couple more years? And I think the Fed's reading on what they're thinking along those lines is ultimately what's going to weigh the most on the 10-year rate.